Bitcoin is a store value, and the ecosystem around Bitcoin wants to, quote, ossify Bitcoin. Not introduce changes, make it always a store value, like digital gold. The bond market is hawkish, thinking the Fed has to hike. Our bet is that inflation is going to undershoot expectations. People are too focused on oil as a driver of inflation, and we've already had the oil shock. By contrast, Ethereum is a yield-bearing asset, roughly a 3% yield, and that's because it's proof of stake. So
artificial intelligence has become the dominant force driving global financial markets. But many investors are asking the same question. Are we witnessing another dot-com bubble, or is this only the beginning? In his latest market outlook, Tom Lee argues that today's AI revolution is fundamentally different from previous speculative bubbles. Lee believes AI is following a similar path. While volatility is inevitable, the underlying technology continues advancing rapidly, and businesses around the world are only beginning to integrate AI into their operations. Unlike the internet bubble, where many companies had little revenue or business models, today's AI leaders are generating enormous cash flow while seeing real enterprise demand.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Well, eventually the AI story is going to become a bubble. I mean, it's fact, because anytime you have a structural demand story and then volatility is underestimated in markets, then people make risk-adjusted adverse decisions because they underestimate the risk. But I don't think we're in the late stages of this AI bubble. The reason I don't believe it's late stages is that as soon as the Korean stock market fell, most people declared a top. If it was a bubble, people would say this is a bottom and they should be plowing into the Korean stock market and into semis, and they haven't. They've been massively selling. So if I was to look at Cisco, okay, and let's just take a short period from 1993 to 2000, okay, a 7-year period, but it was really one cycle, which is the internet build out. Cisco started at 80 cents and in 97 got to $9. Okay, so it had a 10x move. And then in 97, it had a 40% correction. Now in 97, that was at the time of, there was an Asian crisis there, right. Okay? So people would have said, okay, well, the top isn't, the Cisco story's over. Well, it went from $5. By 1998, it went to 18. Okay, so twice its prior high. And then in 98, we had, the Greenspan irrational exuberance and a few other things happening, and like a Russia default, and, long-term capital. And Cisco went from $18 to $9. Okay, so it fell 42%. And a lot of people called the top there in tech. In fact, I remember that period. There were a lot of people that were dancing on the graves of tech saying the trade was over. Cisco went from $9 and by 2000 hit 80. So it had a 100 times move from 93 to 2000. And it was a 5 times rise from its highest high in 1998. And that only took another 18 months. So that's when Cisco really, truly peaked because, as you correctly point out, the last orders were in. Now, keep in mind, in 2000, when I was a tech analyst and I was a research analyst, the top was in 2000 because nobody believed valuations at that point. Cisco was 200 times earnings. Underlying all that was the fiber being laid across the US. These CLECs, in order to justify the valuation of the CLECs, you had to have a 10-year DCF with a 30 exit multiple and a cost of money of like 6%. Unrealistic assumptions. And these were the actual buyers of Cisco equipment, right? They were the true customers. That was a farce. So if someone says, is today that story? It's not. I mean, the number of people using AI is still quite small. It's already showing to be quite productive. the companies buying this equipment, the hyperscalers, they are very, very serious companies. They're not hypesters trying to dig up the ground and sell IRUs. They are companies that are actually buying and putting up racks and getting big orders. So I think it's not a bubble yet. Well, I think that our strategy has been working so far this year because, if you look at what we've liked, our best sort of execution of that is our Granny Shots ETF, GRNY. And year to date, it's outperformed the S&P 500 by like 120 basis points. And it's a top decile fund this year. So we're outperforming more than 92% of all fund managers with Granny. And that's because we stuck with long-term themes. We still believe in AI as a downstream story, and we still believe in cybersecurity and security. And we are betting on monetary easing by the Fed, even though the market's gotten hawkish. And in fact, small caps are doing exceptionally well this year. And that's probably the biggest clue that the Fed's going to be dovish. So I'd say that we didn't make a lot of changes to our view in Granny for the second half. And I think we're sticking with sort of the idea that earnings growth is accelerating, and we're in earnings season now. I think the AI story is very much intact, but we are willing to buy the downstream story. So like Mag 7, software, and crypto are the downstream of AI stories, and they're beginning to outperform. And the other piece is I do think the bond market is hawkish, thinking the Fed has to hike. Our bet is that inflation is going to undershoot expectations. People are too focused on oil as a driver of inflation, and we've already had the oil shock. So I think we've had peak inflationary impact from oil. The underlying inflation drivers are weakening because housing's weak, wages aren't really accelerating, and that would put the Fed in a position to actually cut rates, which would be dovish.
He attributes that success to remaining committed to long-term structural trends rather than reacting emotionally to short-term market swings. Those themes include artificial intelligence, cybersecurity, digital infrastructure, monetary easing, quality technology companies. Rather than chasing temporary market narratives, Lee believes investors should remain focused on businesses benefiting from multi-year technological change.
Well, it's actually a total is close to $5 billion.
$5 billion now.
Yeah.
Excellent. I have some of it. Maybe I'll just invest in that and stop trying to pick bottoms and pick tops.
Yeah. Well, I mean, Granny's an example, when AI and the memory stocks are going up, people were criticizing Granny because we didn't load up on the AI and semi names. And we do have exposure, but when you had a 40% drawdown in memory and AI, Granny outperformed, because we focused on really the anchoring on the longer term ideas within the AI trade.
Right.
Well, just to clarify, BitMine is the largest Ethereum treasury, and actually the largest holder of Ethereum in the world, with almost 5.78 million ETH coins. But it's actually not the first Ethereum treasury. It was probably the fourth or fifth. But we became the biggest, and we just crossed 1 year of operations because we had a very simple strategy. We kept the capital structure very simple, and we wanted to accumulate Ethereum. And so that's how we've been able to grow so rapidly, and we're, I think, 5 times bigger than the next Ethereum treasury. And to contrast us to MicroStrategy, MicroStrategy I'm still quite bullish on. In fact, we own it in the Granny funds because I'm bullish on Bitcoin. But we take a very different approach. One is, the 2 biggest differences, maybe I should highlight 3, but the first is the native asset. Bitcoin is a store value, and the ecosystem around Bitcoin wants to, quote, ossify Bitcoin, not introduce changes, make it always a store value, like digital gold. By contrast, Ethereum is a yield-bearing asset, roughly a 3% yield. And that's because it's proof of stake. So the security work is done by those who are staking ETH, and in return, they get paid a yield. And the ecosystem is developing, and it's the largest ecosystem in crypto, bigger than even Bitcoin. And they are trying to position, and successfully so far, to make Ethereum the financial settlement layer for Wall Street. So the entire financial rails probably will run on stablecoins, which run on Ethereum. The second difference is that MicroStrategy has arguably a somewhat passive approach to Bitcoin, meaning they own it and they want to create digital credit. BitMine is very active in the ecosystem. We've funded we're the lead investor in 3 spinoffs from the Ethereum Foundation, all of which are targeted to strengthen Ethereum and either focused on improving price or strengthening the ecosystem, and there's more. So we are really part of helping shape the future of Ethereum. And the third is balance sheet complexity. MicroStrategy, by design, has a complex balance sheet. They have convertibles, and they have 4 classes of preferred stock, and they have common equity. And in some cases, those components of the balance sheet compete with each other. And because Bitcoin has no native yield, they have to sell stock in order to fund the dividends. BitMine has a very simple capital structure. It has common equity, and we just launched a perpetual preferred. The staking yields that we're generating today at the current price of Ethereum is about $6 million a week, about $300 million a year. If Ethereum goes to 5,000, then this gets close to $1 billion a year, and it would be almost $20 million a week. But our perpetual preferred offering has $30 million a year in dividend requirements. So we can fund our preferred easily with our staking yield. And so I think we have a simple capital structure. We are betting on the future of Ethereum as a settlement layer for not only Wall Street, but for how robots communicate. And we're part of the ecosystem. So I think you should think of BitMine as highly, highly integrated into Ethereum.
Another advantage is Ethereum's staking mechanism. Unlike Bitcoin, Ethereum allows holders to earn staking rewards, creating an ongoing yield while maintaining exposure to the asset itself. This makes Ethereum attractive for institutions seeking both capital appreciation and recurring income. Lee argues this active participation could become a defining feature of Ethereum-focused investment strategies over the coming years. Tom Lee's message is both optimistic and disciplined. He acknowledges that markets will experience corrections and periods of uncertainty, but he argues that these fluctuations should not be mistaken for the end of the AI revolution. Instead, he believes artificial intelligence, cybersecurity, digital infrastructure, and blockchain technology represent long-term structural trends that are still in their early stages.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.